Hi, and thanks for watching. Over the next few minutes, I'm going to walk you through my self-storage acquisition. Now, if you're familiar with any of our A.CRE models, we always start with a versions tab. This tab is where you'll find details about how to learn more about the model, to watch this video and other videos that relate to this model, as well as a change log down here below. You'll see that this video is based on version 1.0 of this self-storage acquisition model. This is actually an adaptation of my value-add apartment acquisition model. And given that the methodology in modeling an apartment deal and a self-storage deal is very similar, I took that to start and added in the self-storage elements to make this self-storage acquisition model. Now, along the bottom, you'll find visible upon downloading the model 2 worksheets, a summary worksheet where largely the results of your analysis are shown. You also have a section where you can add strengths and weaknesses for the deal, as well as a picture. And then down below, you'll see visualize the net operating income by month and cash flow after financing by month. Now, you can also here click the annual report tab. Currently, it's hidden. You click the show, and you'll see now along the bottom that an annual cash flow tab appears. And this, again, just summarizes on an annual basis the cash flow from your underwriting. So I'll come back to summary, click to hide. That's the summary tab. Now, the bulk of this video will talk through underwriting a self-storage acquisition deal using this model. And so if you've used my value-add apartment acquisition model, this will be a refresher. For those who are unfamiliar with that model, I'm going to go section by section, what each section is meant for, where your inputs are, and then to find the outputs or the results of your analysis. So to start along the very top, I have a frozen set of rows. And you'll notice, so as I scroll down, these top 5 rows stay in place. And that's so that you can quickly navigate throughout this model. Now, all of the inputs are housed on this one underwriting tab. Along the left-hand side within the gray section are where you'll find the inputs. Inputs are blue font cells. That's standard convention in real estate financial modeling. Black font cells are either labels or outputs from your analysis. You'll also find an occasional button. And these buttons you can click and they'll do things. So for instance, you would click this button and that would add a line item to your acquisition cost. Likewise, though, coming back to the top, these frozen rows, these are actually buttons that allow you to navigate throughout the model. So for instance, I can click description and it will take me to the description section of the model, investment cash flow, operating cash flow, reversion cash flow, property returns, and then our partnership waterfall. So again, you click these buttons, it'll quickly take you to any portion of the model without having to scroll up and down, which you can also do, of course, but these buttons are meant to get you there quickly. Now, immediately below that header is that investment description section. And within here is where you enter the name of the investment, its location, the land size in acres, the number of buildings, and whether they're multi-story buildings or not. It will then calculate the number of units per acre, the floor to area ratio. Here it automatically calculates the number of storage units in this asset, and the number is entered manually by unit under the operating cash flow section, which we'll get to in a minute. You'll enter the gross buildable square footage, and that differs from the net rentable, where the net rentable is driven by your rent roll, which again, we'll see in the operating cash flow section. We have a management type, which is really either third-party management or self-managed, and then the name of the management company, year built, year renovated, and then your analysis begin date. And then you have the sale date, the month in which the property stabilizes. Now you have the option to model this value add, meaning that there's some sort of lease up or renovation or maybe a change in management that has a period of time where you're not fully stabilized. And so, and again, that's modeled in the operating cash flow section, but it's visualized here, the date in which that occurs, and then the sale month. So that's the investment description section. Let's now turn to the investment cash flow section. Now, if you're familiar with our methodology for modeling real estate cash flows that we teach at Adventures in CRE, you have three general cash flow sections within your property level cash flow. You have the investment cash flow section, the operating cash flow section, and your reversion cash flow section. Investment cash flows are the outflows, those negative cash flows that buy the positive cash flows that you get from the operating cash flow and reversion cash flow section. So in the case of an acquisition, that's most often just simply a purchase price in your analysis start month times 0, maybe some closing costs, maybe some financing costs, and that's the extent of your investment cash flows. However, imagine that there's a value add component here. Perhaps you maybe you're going to add 15 boat storage units upon acquisition. And so I've added here a boat storage construction cost, and let's say it's going to cost you $50,000. You would enter it under the amount column, and then out here to the left, you need to choose the forecast method to forecast those costs. So right now it's set to schedule. Now you'll notice there's an error here, and that the reason why it's erroring out is it's set to schedule. However, down in your operating cash flow section, it assumes all of the units are fully stabilized. So what we would need to do is take this covered boat, set this to 0%, and then we come back up here. And what you'll find is now it's scheduled to spend this $50,000 over each month until all of the units within that boat storage are leased. So that's one way that you can do it. Another way, under method, instead of schedule, you could choose straight line. And the straight line happens over some period of months. So it starts in month 1, it ends in, let's say, month 12. And so you spend $50,000 straight line, meaning an even amount each month, from month 1 through month 12 until you spent all $50,000. Now, another option is S-curve, right? An S-curve is a normal curve where it starts small, grows to some large number in the middle, and then ends up small at the end, right? So a normal curve or an S-curve. And you can do it over some period of months, so let's say 12, or we could go to 6. Now you see out here to the right that the $50,000 is forecast over a 6-month period. Now, in addition, you can choose detail. Now, when you change this to detail out here to the right, you'll see these cells become blue font cells. Blue font, again, being required inputs. You would then need to manually override the formulas that are in these cells and ensure that they add up to 50,000. So if you put some string of values in such that it doesn't add up to 50,000, you'll see it gives you an error warning. So we put that back, and now we have, or in other words, the total amount forecast out here to the right equals the amount in this column here. That's detail. Let's go back to schedule, and then we'll just zero this out. You can add, by default, up to 4 hard costs, up to 5 soft costs. If you want to add rows, you can do that simply by inserting and then copying the row above it down, and or just make sure that you copy the entire row and not just simply the values here. So for instance, you would insert a row, take that row, Control C, take that row, Control V, and now it copied all of this information and all of the formulas out here to the right. Okay. So that's how you would add a row to any of these sections if you wanted. Now, the one little trick is make sure that you add that row with not add the row at the bottom or the top, but in the center of that range. And that will ensure that your formatting and all of the formulas stay correct. So that is the investment cash flow section. In total adds up to, in this case, 6.5 million. It's the sum of your acquisition costs, hard costs, soft costs, to get to a total project cost without financing. You add in any financing costs, and you get to your total project cost. Now, also within the investment cash flow, after we get done with modeling our uses, we then look at our sources. So this is a summary of our uses. Our sources then are the sources of capital to cover the uses that we have. So in this case, We need to come up with 6.5 million. We can do that in some combination of equity and debt. So your equity, again, is your down payment, and you can have up to 2 partners. Well, you can actually have up to 3 partners, but here you have a GP equity and you have LP equity. And then down in the waterfall, you can choose to have a double promote where you have 2 GPs. But in this case, you choose between what percentage is GP equity versus LP equity. Let's imagine 5% is GP. The LP comes up with the balance. Then let's assume you have 65% loan to cost loan, or a $4.23 million loan. It automatically calculates the equity that is required by the GP as well as the equity required by the LP, inclusive of fees. You'll see that amount here. Okay, so those are sources of capital. Now, on the debt side, you can choose up to 2 types of debt for your initial financing. So, for instance, I have 65% loan to cost on my senior. Let's say we add a 15% of cost junior loan, maybe mezz, or secondary financing of some sort. And now that reduces the amount of equity required. Here we're 80% loan to cost, 81.35% loan to purchase price. So that's our sources. Now down below here we have now our financing assumption. So this is the initial financing. Currently a loan term goes out 48 months. And this is really driven by the length of your analysis period. A little further down, we'll talk about how you set the length of your analysis period. But by default, the term of your initial financing is set to be equal to your analysis period. Now, if you want to have a mid-hold refinance, either you have a value add deal, and so you have some sort of bridge financing and you want to take that out with permanent financing, or you've got existing debt that needs to be refied mid-hold, you'd go ahead and click this refi button. And when you do that, it opens up a subsequent financing section. And you just have to ensure that the loan term on the initial financing is less than the analysis period. So right now, 48 months, let's take this to 24 months. And what this does then is the subsequent financing kicks in month 24. It's our funding month. And the payoff, of course, is the end of the analysis period. And here then you could set different financing assumptions. So we need to ensure that there's at least enough to pay off the senior. So let's go to 80%, 5206. That's enough to pay off the initial financing, 5206. But maybe we go a little higher than that. I don't know. Actually, yeah, let's say 20%. Borrow 85% of cost. Now the loan amount in month 24, when this funds, will actually be in excess of the payoff, and therefore there will be some proceeds from that refinance that will be distributed back to the partners. You can also enter initial financing. You have the term, and then you have how much of that term is interest only, and then some amortization to calculate the amortization payment. Right now, if your IO or your interest only period matches your term, then this won't have any impact. If this is less in your term, then you will have amortizing payments for whatever the difference is between your remaining loan term and your interest only period. Here you then have an interest rate for each of your tranches of debt. So for instance, 3 1/4 and 10. But all these are blue font cells, required cells that you would update. So, and then the same inputs down here for subsequent debt if you so choose. Go ahead and undo those. Go back to cell. So that is financing assumptions and the end of our investment cash flow section. So we covered kind of our project costs, the sources to cover those costs, and then financing. Now let's move to operating cash flow. So there's a lot going on here. This top section is where you enter just some basic assumptions about growth rate. So you have in-place rent, stabilized rent, other income, operating expenses, excluding taxes, property taxes, and CapEx, and then some growth rates for each. Now, the reason why this is 0% is the growth occurs on the first month of the new year. And so it's assumed that there's no growth from your stabilized pro forma or your in-place pro forma, and I'll talk about that in a minute, to your actual cash flow. So your first growth period occurs on month 1 of year 2, another growth month 1 of year 3, month 1 of year 4, month 1 of year 5, and then month 1 of every year thereafter. And these are the rates for each of these lines. Then over here to the right, we have that stabilization concept that I talked about. So right now, if I look here to my unit types, I can set a unit type, right? And these are just labels. So I've got a 5x5, I got a 5x10, I got a 5x15. These are all if I go out here to the unit type non-climate controlled. And then down here, I've got climate controlled and a 5x10, 10x10, 10x15. I set the number of units for each unit type, the square footage for each unit type, and then I set what percentage of these units are stabilized. Okay, and in the context of self-storage, there's not as much renovation like there is in apartments, right? And this model or this concept came originally from my value-add apartment acquisition model, and the idea goes that, hey, you renovate a unit and you can bump the rent in that unit. Nevertheless, the concept still applies, either in the sense that you think that the rent is under market and you expect to roll that unit to an above market, or you expect to roll that unit to a market rent or a stabilized rent, or perhaps you are going to do some renovation. Maybe you're going to add climate control to it, and in doing, rents will increase. Or in the case that I talked about, this covered boat concept, here you'll notice I have 0% stabilized, 15 units. If I set the in-place rent to 0, what that's saying is, in place, there's no rent earned from these 15 units. And that's because these units actually have not been built yet. But if I were to, and now I come back to this upper right hand stabilization, if I were to say, okay, let's begin delivering these units in month 6, and let's finish in month 12. So over a 7-month period, month 6, 7, 8, 9, 10, 11, 12, we will be leasing up these covered boat units. And so if I come out here to the right, and I'll be leasing them at $175 per month per unit. Come out here to the right, you'll see that we earn no income during the first 5 months. And then in month 6, we deliver the first unit. We deliver 2 units. You'll see here the units being delivered. And then over time, that amount grows until we hit full capacity. Month 12, we've leased up all 15 of these covered boat units. We're making $26.25 a month from those 15 units. And then you'll notice in month 13, the first month of year 2, there's a bump. That's a bump in rent. That's because of the 2% there. And that bump will continue 2% each year thereafter. So that is, in this upper right-hand corner, the stabilization timing and frequency, a begin and end for that. And then this tells you how long of a period that stabilization will occur. What you also have is the option to do a custom roll. So right now, the units are automatically calculated how many of them are rolled to stabilized. But if we were to toggle this to yes, you'll see that down here, there's this percent rolled to market. It's really percent rolled to stabilize. And you can update this percentage so that you approximate, and this, by the way, is the percentage of all units. You approximate the percentage until you hit 100%. Once you get to 100%, you're fully stabilized. So that's the custom roll feature. And then finally, this investment type, it really is just telling you in month 0, is this fully stabilized or not? And it's not, obviously, and the in-place income is lower than the stabilized income, and that means, and there is less than 100% of the units that are stabilized. But if I were to go to 100% here, and let's take this back to, this doesn't really matter because these are 100% stabilized now. You'll see that this goes to stabilized. You'll see that this is now 100%, and this boat, these covered boat slip, covered boat spaces are now earning us income from day 1. Now, off to the left here, you've got this in-place section and the stabilized section. And what this is So for instance, covered boat, when we go to 0, what this does is until month 6, all rent for this one unit type is based on this value, not based on this value. And as these units roll to stabilized, you get progressively less of this and more of this. And that flows through to our other income and our operating expense line items. So for instance, in the case of the covered boat, it would, let's say that, I don't know, we're going to add some security for these. And so we're going to go from 10 per unit per year to, I don't know, 12. Now, as these roll to stabilized, this line item for security will slowly roll, and it's not much, from an in-place 62.82 to a stabilized 63.12. And so anyway, that's the in-place versus stabilized concept. Let me go ahead and put this back to 100%. And now we're our stabilized acquisition. So then we have the adjustments to our gross rent. And there's a few options. The first is downtime vacancy. And this really relates to units that are rolling. You want to decide, okay, how much of a given month would as that unit rolls to stabilize, is it going to be vacant or not, is really what we're asking here. And in the case of, say, you're going to take, maybe you're going to take an entire building and you're going to renovate the building and those units are going to be down 100% during that period, you would set that percentage of month. If you had multiple months, you might go 300%. That would be 3 months. In the case of the covered boat here, that would also be 100% until those units are leased up. But in most cases, you won't touch this number. And then we have concessions free rent. Again, there's an in-place free rent and a stabilized free rent. So for every 13-month typical lease term, all right, and in the case of self-storage, they may be on a month-to-month. This is the average length that a customer, a tenant, is in that unit. So if it was in 13 months, in this case, we would give 1 free month for every 13 months of average length. Here's the adjustment to rent that free rent results in. We also have the option for non-revenue units. Maybe you keep a couple of units for models to show units off, or maybe you have units down where you store things on site. So that's taking some of these, in this case, 426 units, and pulling them out of service so they're not rented. Then we have other income. Again, we have 6 line items, kind of standard line items you'll see in a self-storage pro forma or operating statement. You can change these as you wish. You can add rows the same way we added rows up in the operating cash flow section. And then you enter the amount per unit per lease. And this is a little unique. And the reason I did it this way is oftentimes the amount that you earn is a one-time fee. So sign-up fees, admin fees, late fees are an average over the entire lease. Vending might be an average over the entire lease. So for one unit, for instance, in vending, you would expect to make $2.50 over the, in this case, 13-month period in vending, and then just miscellaneous other income. So those are our other income line items. And the amounts actually are driven in part by the average length. So if our average length is only 6 months, you're going to earn more because you have more turnover. Therefore, you have more sign-up fees, you have more admin fees. And if we're assuming $250 in vending for an entire 6-month period, or I'm sorry, for an entire length in which a tenant is in the space, then you would have a higher amount, because this is ultimately calculating on an annual basis. And so you get 2 sign-up fees in a year rather than 1 sign-up fee in every 13 months in this case. So that's other income. And of course, we have general vacancy. There's an in-place and there's a stabilized, as well as credit loss. And there's the option here, by default, the general vacancy is calculated simply as a percentage, and that percentage persists through the entire analysis. But let's say you want to detail out your vacancy rate by month. You just simply toggle this to detailed, Then you come right up here, you'll see this line, detailed vacancy, and then out to the right, you can set the vacancy by month. So that's how you add some detail to your vacancy. Let's put this back to standard. So that gets us to effective gross revenue. Now let's talk operating expenses. Now these assumptions are generally per unit per year, and we have some common operating expense line items for a self-storage building. These are blue font though, if you want to change or move these around. You have a management fee, and that's a percentage of effective gross revenue. Then you have an insurance line and a property tax line. Now the property tax line automatically calculates for you in place and stabilize the millage rate. And that way you can underwrite your property tax appropriately. That gets us to total operating expenses. I have a quick metric here, your expense ratio. Your expenses are often 40 to 50% of your effective gross revenue. And so this is a line item where you can track that. Then we subtract from effective gross revenue your total operating expenses to get net operating income here. This is in place and stabilized, and then you can see the actual cash flows out here to the right. These are the cash flows that flow in to calculate your returns. We subtract out capital expenditures to get to our cash flow from operations. We then have debt service, up to 4 types of debt, depending on whether you have senior and junior and whether you have subsequent debt or not. And we get to a cash flow after financing line. And with that, we've finished the operating cash flow section. We then can go to reversion cash flow. Now, reversion cash flow refers to the expected value of the property at the end of your analysis period. So whether you intend to sell it at the end of your analysis period, or you're just simply doing a 10-year analysis to determine the returns over that period, this is where you're going to estimate that value. Now there's 3 pro formas here that then from that pro forma, we do a direct cap valuation, or we take net operating income, we divide that by some market cap rate. The market cap rate is set here. That's the market cap rate today. Here's the market cap rate at sale, or terminal cap rate, or reversion cap rate. Some selling cost assumptions here. Also out here to the right, it's calculating the stabilized month, so that on the left here we see timing. And so this is estimating your construction end. And in the case of a stabilized, there is no construction, so it ends at the very beginning. And then your first fully stabilized month, again, this is a stabilized deal, therefore month 1, you're fully stabilized. Now, I've mentioned along the way that sale month. So the month or the end of your analysis period. And this is a blue font cell. You should change this for the value that you wish to use. For a stabilized deal, 120 months, 10-year analysis is fairly common. But if you're doing a value add deal, this will actually automatically calculate a period that's 12 months following your construction end. 12 months following your stabilized date. And so, but nevertheless, it's important that you review this date, or this month, and ensure that this month is the correct month for your analysis. So then again, we have these pro formas. This is automatically pulled down from up above. And then this is as of the sale month, or that month there. And you'll notice it's blue. So it automatically pulls the forward-looking 12 months, so month 121 through month 132. Nevertheless, you should review your reversion pro forma to ensure that it's accurate, especially the property taxes. In some states, there will be a reassessment at sale, and the property taxes might bump. And so the person who's doing that assessment 10 years from now, 120 months from now, is likely going to be using a higher property tax value than what is in here. And so you'll want to review these values. That gets us to a net operating income for in place, stabilized, and then at sale. And then we see the value here, stabilized value in place, value in place, value stabilized, and then value at sale 10 years from now. And you see the per unit and the per square foot in the case of US deal. So that's the reversion cash flow section. Not finally, I guess, but the end of our property level analysis, we have the return section. First, property level cash flows. Again, investment cash flows, operating cash flows, reversion cash flows. We get to our net cash flow line, unlevered and levered. And then you see here to the right, property level returns, both equity multiple and internal rate of return. You also have a net profit number. Also for stabilized deals, for value add deals, there's a yield on cost relative to market cap rate analysis that you can do. For a stabilized deal, that's irrelevant. And so those are your property level cash flows. We then get into the waterfall. And here in the waterfall is where you model out the partnership level cash flow. So we take the net levered cash flow line from the property, and that flows to the partners. And so the partners then either have contribution requirements, meaning they have to contribute capital to the venture, or they receive distributions. And so here you're going to enter things like GP fees, if there are any, asset management fees, again, paid to the GP if there are any. You can toggle this off altogether if you don't want to include those fees in your partnership level cash flow analysis. And then below, you set the distribution, the contribution share is based on what was in the sources, right? So 5% from the GP, 95% from the LP. But the distributions to each are modeled here. So you have in this case, 4-tier waterfall. You have a preferred return tier. These are IRR hurdles. And so you have to have a return of capital in order to hit an IRR hurdle. And so that's why you don't see return of capital is built into this pref hurdle. And so let's say up to a 9, the split is 95-5. But then there's a promote paid by the partnership to the GP from a 9 to a 12. And so if the GP earns a 10% promote, the GP, given that the GP owns 5% of the partnership, would be distributed 14.5% of the cash flows in the second tier. Split to the LP would be 85.5%. And then these would be the splits based on these promotes up to these hurdles. So using this distribution, these distribution inputs, as well as the contribution inputs, here we get distributions to the GP, distribution or fees paid to the GP, and then distributions to the LP. And you see the percentage of total distributions between the GP's real estate distributions, the GP's fees, and then the LP's real estate distributions, and then the net cash flow for the GP and the LP. Now, there's one other feature here. We can go back up to this top bar. What you see is, by default, the levered internal rate of return at the property level and the levered equity multiple at the property level are automatically shown to you in this in this header section. So as we make changes to our underwriting, let's say we change the price from 6.4 to 6.3, you're going to see that those values automatically update. And that's just a quick way so you can see the impact of the inputs that you're entering into your underwriting tab. And so that is a walkthrough of my self-storage acquisition model. Please let me know if you find bugs. This is version 1.0 of the model. There are likely bugs here. I adapted this from my value-add apartment acquisition model, which is quite advanced. Nevertheless, there will likely be things that need to be fixed. So please let me know what those are. I'll roll out updates as bug reports come in. And otherwise, thanks for your time.